Hi, this is Johnston from Centric Wealth Advisory. This is a spreadsheet that I'd like to share with you to explain how one can analyze property when looking to purchase for investment purposes. This is more of my area of expertise where I have specialized in doing financial models for investment property over the last 6 years. This is more of a practical way to look at property, looking at numbers a little more deeply. This is more of an exciting template for those who are looking to understand property and also go through the template with me. The link to download this template is in the description of this video, but I'm going to try and go through this video as slowly as possible so that people understand how to actually analyze property and not just use simple metrics such as gross and net yield. There's a lot more elements one needs to look at, especially if you're looking at the leveraging component of property. So I'm going to do a share screen now to go through this template that I've created. This template has really been designed to illustrate the realities of investing in property, the risks that are associated to that, and obviously the different variables one needs to consider when looking at property compared to traditional investments. In other words, unit trusts, endowments, retirement annuities, etc. This template might be quite daunting when you see it for the first time. I do understand that. Investing in property is a very complex thing. There's a lot of elements one needs to be aware of when you're leveraging from the banks, getting money from the banks. In other words, if you're finding a tenant, how long is it going to take for you to break even? If there's vacancies in a year, in other words, how many months will the unit be empty? All of that you need to factor into the calculations to determine the feasibility of property. There is a lot of ratios, a few calculations over here. I'm going to go through this section first using an example of a property. I haven't given it a name, but if you are prospecting a property that you see online, whether it be directly from a developer off plan, or if you are purchasing it from an existing development where it's already built, might have an existing owner, then you need to factor in purchase price is over R1 million. And of course, obviously transfer costs for the conveyances to transfer the property to you through the deeds office. Then it gets a lot more complex than that. You might be buying the property in a company or in a trust. I would speak to a specialist that would be able to advise you accordingly. But for this video, I'm going to explain how one would look at property from an investment point of view and what to look out for when you're factoring in your returns and then comparing that to a traditional investment. The property in question, now just bear in mind, investment property can vary from a 750,000 Rand property up to around about a 1.5 million. The reason why I'm saying that is because the more expensive a property is, the rent relative to that property will be lower. In other words, a 1.5 million Rand property, ideally the rent should be 15,000. But the reason why it is not is because tenants are not going to pay 15,000 if the bond is 14,630. They might just decide, well, if I have to pay 15,000 for this, I might as well buy the property and then factor in your levies, etc. In other words, they own the property because they're paying the landlord to stay there anyway. So therefore, what we call is the rent to value. And the rent to value, RVR, in this case, in this hypothetical scenario, we said that the rent is 80% or 0.8% relevant to the rental amount. In other words, if you take 12,000 times 12 divided by your purchase price, you will get an, sorry, in fact, in this case, you're going to take 12 divided by 1.5 million to get to your ratio. So in other words, 12,000 Rand directly proportionate to the purchase price is 0.8. Ideal one would be 1, to illustrate that. The 1 is over there. 1 meaning that it is directly proportionate. The ideal situation would be getting, let's say, 16,000 Rand rent and a 1.5 million. Your RVR is going to be 1.07, which is great, obviously. But the reality is that we want to look on 12,000 because that's really what you're probably going to advertise it for. Let's work on a 30-year bond for now. Work on a 10% deposit. So let's say this person bought the property for 1.5 million Rand. He's expecting to get 12,000 Rand rental. That's what's being advertised. Let's say it's off plan. The HOA or levy, depending if it's in a secured development sectional title or if it's plot or plan. Let's actually make it a bit easier and say 1,500. Obviously depends on location. Let's say the rates is 900. And now we can then factor in the deposit of 10%, the finance terms 30 years, that's the maximum one can get. And let's work on prime. Unfortunately, property in South Africa is quite expensive to finance. 11.75% is quite high for the prime lending rates. Some investors or people might, or purchasers for primary residence, as an example, might get below prime. Some with poor credit scores will get above prime. But the idea, of course, is if you take out a longer finance term, your installment will be lower regardless of the interest rate. And I'm going to show you now. So it's 13,627. If I put it on 20 years, it goes to 14,670. It just simply means that it's got 240 payments versus 260 payments. And obviously depends on your affordability and cash flow. We're working on a growth rate of 6%. I'll make it 8%. Let's say it's in the Western Cape, rental escalations of 6%. In reality, escalating rentals by 6% is challenging in certain areas because you're expecting your tenant to be able to afford a 6% escalation yearly relative to their salaries and their costs, their own personal expenses increasing. Inflation 6%, rental management we're saying is 10. It depends on which rental company you use, but if you use some companies, it's 10% plus VAT. I'm just going to use 10% for now because this is just an example. And then we can start plotting the cash flow per year based on these assumptions to determine when will the property break even, and also what is the expected equity market value increasing over time. And of course, obviously your outstanding bond will reduce through amortization. So in this case, the 12,000 rentals putting through over here, your 1.5 million has grown by 8% after the first year to a value of 1.620. Again, that is really comes down to supply and demand. If you're in a very high demand area, you probably will get an 8% escalation because it depends on who's buying there and how often. Supply and demand. If you've got high demand and low supply, the price is going to go up. And that's what happens in certain areas for property. So let's just work on 8% because it's just an example. The total payments are 17,000, which is summing up your bond, which you've already calculated in 30 years. Your property management, which we've calculated as 10%. So 10% of 12,000 is 1,200. Said your levy is 1,500 and your rate is 900. So taking your income minus your expenses, this investor is expecting to have a shortfall of 5,227 Rand per month. And then annually, that's 62,724. And as we go into year 2, escalating your rental by 6%, the bond stays the same, assuming the interest rate remains unchanged. Your percentage is the same, so 10% of the rent. The levies are increasing at 6% and your rates are increasing at 6%. So you can see that the monthly and annual expense drops because you're escalating your cash flow. As time goes by, you will see that this property will reach a point what we call break even, where your income exceeds your expenses. In this case, it's 565 Rand surplus, or 6,675. So what we want to now look at is, what is the total expenditure that I've incurred to get to this point? So we're saying 313,395. That is my out-of-pocket opportunity cost to fund this investment, to get it to the point where it can fund itself. There are ways to get there quicker. This amount here is excluding the 10% deposit. Deposit's 150. So you've got to take that amount I've just shown you here, adding the 150 to get to 463,395. And the explanation, total capital invested, including upfront deposit, transfer cost, transfer duty. I've not included transfer cost, transfer duty. If you were to put in transfer cost, transfer duty, it would then factor that in. Why? Because it's an upfront expense over and above the deposit, because it's part of your investment. I'm buying this property. What is my opportunity cost that I'm going to be incurring upfront and ongoing to the point where it funds itself? Now, you might be asking, well, why would I want to go and put in 463,000 Rand into this property over a period of 9 years to break even in my year 10? Why would I want to do that? Especially when you've got high interest rates, etc. The reason why one would do that, and of course, obviously, it is an objective view here, is one would look at the leveraging component of property, and it's all relative to affordability, etc. Leveraging means using other people's money, in this case, using the 12,000 Rands to help fund your investments to reduce your shortfalls to 5,227. Quite simply, if I didn't have a rental of 12, your expenses would be 12,227 and nothing to offset it. So the idea behind the principle of investing in property, this is not the ideal situation. You ideally want to be breaking even immediately, which I'll show you an example just now. But you're looking at the market value minus outstanding bond, and you've got the equity. The equity is the difference between the two. And the best way to explain that is the value in your bond that you could potentially refinance, because your property is an asset appreciating, your bond is reducing through amortization. So in theory, if your property is worth 1.62 million, and you go to the bank and say, I would like to refinance 275,000 because my property has grown 8%, if the bank sees the value, they will allow you to take a further loan of 275,000 from this property, and that can be used elsewhere. And as time goes by, as this property is appreciating further and further, and your bond is reducing because of amortization, your equity per year is going to increase, which you can unlock through refinancing in the future. If you've got the affordability, you can't just go to the bank and say, I'd like to use that money. They need to see your income at that stage and your affordability to see if there is the potential for you to do that. But let's just look at year 10 when you've broken even. The properties are making a surplus of 675 Rand for the year. And you're taking the market value, which is now this amount adjusted by 8% over the 10 years. Then the 10 year is looking at 3.238 million. And your equity, because of your outstanding bond, is now 1.98 million Rand. So what one can look at now is, let's look at 10 years first. What is the surplus income, if applicable, plus the equity that I've now unlocked? Because you could essentially refinance this amount. We're using the surplus here, plus obviously your income and other revenue sources to show the banks that you can afford to refinance. But as an investment return, you will then look at what is the equity plus any surplus capital. In this case, there's none. You're looking at 1,987,717. And the reason why we are looking at that, because we're also adding the 6,775 to that. So there's actually just a very small portion in your 10th year, which we add into the equity. So we're looking at 1,987,717. that is the amount at break even, or after 10 years, sorry, because we're looking at 10 years. And if you took the equivalent 463,395 and you invested that up front and got an investment return of 12% 10 years from now, you would have a fund value, a future value of 1,439,234. So we're assuming, instead of taking this 150,000 and spreading out the costs over 10 years, we're just assuming you're taking 463,395 and you invested that as an opportunity cost into a fund, and you grew that 12% compounding for 10 years. The growth would be 211% on your 463,395 versus 329 on your leveraged component. Now, just bear in mind, this 1.987, that is not money that is sitting in your account that you can use. You still have to unlock this through refinancing. But the principle behind this is that if you unlock this capital, not the full amount you can use, whatever amount up to 1.987, you will be able to use that money to purchase further property as deposits without having to dispose of this property, because you're not selling the property, you're refinancing. So this loan that you take out is tax-free because it is not income in terms of the Income Tax Act, and it is not a capital gain disposal because you're not selling the property. So let's say this person took out R1,000,000 from this bond and left 987. Obviously, it's going to readjust and recalculate the installment. But let's just say took R1,000,000 out and used that money to purchase further properties, etc. Then the idea is they want to build up additional properties in their portfolio and also have additional rental from that over time. Now, the only issue is, of course, is that we are working on an 8% market, which is, we're saying equity is market value minus outstanding bond. So let's say the property only got you a 6% growth rate. Now we can see comparatively 1.435 million. The cash flow is the same because the rental escalation was identical and everything else. However, we're saying the market value is inflation. We're looking at 1,435,601 versus 1,439,234. So it's 210% versus 211. Now it's very comparative. So now, if I'm a financial planner objectively, I would say that if you looked at this particular scenario of numbers, and I've just made this up now, I haven't really much thought into this, is if I'm investing in property versus in a traditional investment over 10 years, it is either or. If you can get a 12% consistent compound return every year, makes sense. Obviously, there's other elements, such as tax on your interest, etc., depending on which investment vehicle you're going to. Whereas with property, you are writing off losses, which you will carry forward. You're unlocking this equity, but again, you might not be able to unlock this capital depending on future affordability. So there's pros and cons, but this is just the principle mathematically how one would look at it. Then you also need to look at potentially maybe a vacancy. You might factor in 1 month's vacancy. You get 11 months worth of rental instead of 12, looking at 211 versus 131%. Why? Because we are saying that in a 12-month cycle of rental, you get 11 months and not 12. So that's not great. So 8.3%, which is just basically working out a percentage of vacancy a year. Now, of course, if your property is vacant for 50%, definitely not an investment. You're making a loss because your cash flow has dropped so much. Your expenses are never going to break even. It's going to take you 30 years, and it's only because it's a 30-year tracking period that we're looking at. Let's put it back on naught. And now let's compare. This is the best case scenario. You'd never have a tenant vacate and have a month where you don't have a rental. Let's look at 20 years now. So the thing I want to show you is that property is a long-term investment, unfortunately, because when you've broken even now in your 10th year, you now have to sum up all the surplus and then also look at equity in year 20. So now going to that scenario, we're taking the equity. Now just bear in mind, I have made the 6%. I've done it on purpose. There's now been a bit more realistic, the escalations or capital appreciation of property. But if I took your total cash flow and I round it up to 20 years, you should get to 437,500 plus the equity of 3.851 million. Gets you to your 4.6 million over there. Equivalently, if it took 463,395, which reestablished as 150 plus the cash flow to break even, and you invested that and got 12% over 20 years, you're looking at 4.470 million, which is a return of 865% over that period. It's not compounded. It obviously compounded, it would be 12%, but this just shows you the total return just as a comparison. Again, factoring in vacancy, it makes quite a big difference if you have 1 month the tenant not paying or tenant moves out, whatever. You can see it's 597% versus 865. So again, property, really, if you're leveraging a lot more risk, let's put it back on 0 and let's increase the opportunity cost to 50%. This person breaks even immediately. You could just put him down 50%, but his opportunity cost is now 750. There was no shortfall, so it's just purely 750, which is the 50% purchase price. So let's put it on 10, let's put it on 10 years. Do the same scenario. You will see that just on the cash flow now, plus the, now, because there's a less bond starting off, equity is obviously going to change. So now we can see the equity of the 10 years is 1.987 million plus the accumulated cash flow, which is 420,155. Add the two together, you get 2.4 million. 750 invested at 12% compounded annually at over 10 years, you'll get 211. So again, you might say, wow, if I buy the property at 50% leveraging, and I achieve all these assumptions, I will get to 221% return, and I'll still have equity that I can unlock. And now, in reality, this is a bit more favorable for property, if I'm honest, because you need to reinvest the surplus. And secondly, the potential to unlock your equity is greater because you've got a surplus income that you can now reflect. So that's not taking that into consideration. But if I was to put in 1 month's vacancy again, we can see that even with 11 months, 199% versus 211. So this is where it's favorable, but you are looking at quite a big opportunity cost of 50%. Put it back a note, let's change it to 10 to 20 years. So now, because you're compounding at 12% over a 20-year term using exactly the same scenario, it's 6.168 million, which is summing up all the surplus cash flow plus the equity after 20 years, gets you to 722% versus taking the same 750, investing that for 20 years at 12% compounding annually to 865. Now then, if you go and add in a vacancy, you can see at 622 versus 865. So you've got to decide as an investor what opportunity cost makes sense for you. Again, as I've mentioned, just bear in mind to be objective here, we have not factored the reinvestment of the cash flow and also refinancing of this property. So if you were to go and take out a portion of this property's equity and reinvest that back into another property, then you're looking at 2 properties versus 1 investment. Obviously, you might look at the opportunity cost on the second investment because you might not get the same loan to value. In other words, what percentage of deposit you can put down. That's a discussion for another template. I've got many templates where you can factor that in. But the point is that on face value, one needs to look at the opportunity cost between the two. And in reality, from an investment point of view, which we call the internal rate of return, the less money you use as an investor, the greater the internal rate of return is going to be. So to explain that, I'm going to now put it back on the original assumptions over here. Naught. And I'm now going to just quickly show you the internal rate of return. So what we want to firstly look at is, okay, we've looked at the cash flow, we've compared between traditional investment versus a property. Now, you might want to be comparing two properties against one another, because now you've compared it against the traditional investment. To do that, you want to determine the net present value and also the internal rate of return. The two work hand in hand when calculating, firstly, the net present value. The net present value will then be used to determine what is the feasibility of this project by using the internal rate of return as the discounting factor or discount rate. I'm going to get to that now. So the net present value is taking your upfront cost as the outflow, and that it measures the cash flow per year, which is obviously the annual cash flow, and we discount that back to present terms. So now I'm going to use 6%, which is inflation. And I'm going to say for this particular property, the outflow was 150,000 because it was the deposit of 10%. The cash flow in year one was 62,724, 56,776, 50,043, 36, etc., etc. But you need to discount that back to present terms because this is future cash flow, which has been adjusted by all these assumptions over here. So 62,424 discounted by 6% is 55,255. In year two, it's 43. Year three, it's 34. Year four is 26, so on and so on. And as the property is nearing breaking even, obviously you can see the cash flow is reducing in future terms, discounted it back to present. It's actually a surplus year 10 in both cases, but now because the buying power of 6,775 is 1,907 in today's terms. Talking about if you're looking at using surplus money, what does that surplus money in today's terms mean? And that's the amount over here. Then we discount the equity, which is 1.428 million by the 6%, you get to 354,195. The discount rate, just put it, sorry, it actually should be 6%. This is the 6%. So this is the amount adjusted by the 6% to inflation. So 56,776 adjusted by 6% back to present terms is 50,454, 59 in year one, year two, year three, year four, and this is obviously year 10. This discount rate, you can choose whatever amount you want. It's actually known as the weighted average cost of capital. You've got to factor in other things into your cash flow analysis. I'm just working on 6% for now. And if we work on 6% and you get a return, which means that anything above naught means this property is feasible in terms of purchasing. Now, obviously, you can take two different properties and compare the two and see which one has a better net present value. Obviously, there might be different variables such as loan terms, deposit, etc., etc. But really what you want to do is you want to see how feasible this property is over a 10-year period. Over 20 years, working on 6%, obviously calculates the same net present values, but it goes for 20 years. We can see that the net present value is now obviously giving you a positive return of 1,009,142, which means that this property is definitely feasible. However, now let's firstly back to an internal rate of return, and then I'm going to put it back onto 6%. Then I'm going to change the cash outflow to a higher amount and show you how the internal rate of return is going to change. So what we do now is we take the same cash flow. We don't use the discounted rate. We use the normal cash flow, and we work out the internal rate of return. How hard is my money working to get to the equity that I'm achieving after 10 years? The equity is taken over here. So we're taking all the outflows eventually to break even in year 10 to get to an equity amount of 1.428 million. And if we work out the return rate of return, we are working out that the money is working at a rate of 13.52%. So you put in 150,000 in, you put in an additional 62, 56, 50, 43, etc., and then you get into a big outpay, or sorry, a big growth up to 1.428 million, because essentially it's an investment return, which means that the cash flow that you've outflowed to get to this has worked at a rate of, the amount you've invested to get to a future return after 10 years has a return rate of return of 13.52%. And over 20 years, doing exactly the same calculation, but over a 20-year period, you're looking at 13.61%. Now, if you now use the discount rate equal to the internal rate of return, which is 13.52%, by clicking that button, your discount rate equal to your internal return will result in a net present value of naught. So in layman's terms, if I were to discount, or my weighted average cost of capital was 13.52% based on all your calculations and assumptions and all the different variables over a 10-year period, anything above 13.52%, let's say it's 14, this property is not worth pursuing. Now, of course, the difference between 13.52 and 6 is quite a big difference. So there's a bit of a leeway. There's a bit of leeway for you to actually play around with your weighted average. But the point being is that 13.52% being quite a high number means that this property is quite feasible. If I do exactly the same scenario, taking 13.61 and I put that in as the discount rate, exactly the same thing happens. Return is 0. If you make this 14%, it's going to be a negative return, not worth it. Now, let me put it back on 6. And again, if you're going through this with me, pause the video, do it yourself, continue watching so that you understand why I'm doing this. It's quite important because we're working on cash flows here and we're looking at leveraged cash flows, which means that your internal rate of return is going to be fairly high. If I go make this naught, then your internal rate of return is 14.43% and 14.04. Why? Because there was no outflow initially. However, there was losses over the 10 years to unlock equity, which is the difference between the market value minus outstanding bond of the 10 years. Your leeway is 14.43, which is higher than we originally had because we put down the 10%. Now, on the converse of that, if I bought this property cash 100%, your internal rates of return reduces to 11.85. That's still fairly good, if I'm honest. 11.85%, inflation 6. So if you were to go and use your internal return as the discounting factor, anything above 11.85% in your calculations would mean this property is not feasible if you bought it cash. Now, bearing in mind, as I've shown you before, we need to look at the investment return of 1.5 million going into your property versus an investment. Let's put it over 10 years. It's 168 versus 211 because you're taking the market growth at 6% plus the accumulated cash flow. So it's 1.3 plus 2.686 to get you 4 million versus taking 1.5, investing it over 10 years, compounding at 12%. So again, there's a few things you need to look at, which is why I've included both. Firstly, to compare your investment versus traditional investments over here. This is for 10 years. This is for 20 years. So it's now 8.5 versus 14.469. Obviously, 12% is quite high. But again, if you're investing long term, you're going to have a financial advisor put you into an asset class mix that would be a bit of offshore, local, etc., to get you to that return. But it's working on 10. It's working 10% now. 8.5 versus 10. Of course, over 10 years, you might have an outperformance in the property. You will. property outperforms over the 10-year period. So again, put a property in, play around with the scenarios, do your research, play around with the numbers. Let's put back in 12 until you're comfortable with a scenario that works for you. But as you can see here, property is quite a complex investment vehicle to get into. So going back to what I showed you here, 11.85, and then with this over here, we discounted back by the internal rate of return gets you to naught. So anything above, over 20 years, anything above 12.4%, which is a very high discounting factor. So it is very feasible. And that's based on 100% cash. There's no bond. Then you can see the feasibility of this property from an internal rate of return net present value makes sense. The next factor, of course, now is you need to determine, do I invest my money into this property if it's cash versus an investment over 10 years? If I can get the 12%, if I get the 10, as I've shown you already, it does show you 1,681 versus 159, but then you might want to factor in 1 month vacancy for the property. It's 157, 159. So I think this is more of a realistic scenario over 10 years. You've had a 1.5 million property getting 12,000 rent, 1 month's vacancy, so you get 11 months rental. 1,500 is the levy, 900 is the rates. This is the assumptions over here, 10% rental management fee, 11.5%. Prime, obviously prime's going to come down over time, but it's just a model. This is a scenario where you might be like, okay, yeah, property does make sense, because yes, it's growing, but I'm also be able to reinvest the surplus. With this investment, the money has to compound, so you can't take any money out. So this is where the scenario might lean towards property. Let's have a look over 20 years. Okay, so 20 years, you've invested longer, and you don't reinvest this wisely, go to a traditional fund. It does make more sense. There are further calculations over here, which is really just working out the intended return as a snapshot over 5, 10, and 20 years. And then obviously traditional investments, this just shows you how to work out the intended return and the equivalents over here. This I'll let you to read through. There's 2 graphs over here illustrating the equity proportionate to market value. Just bear in mind, the equity equals market value if it's cash, because obviously there's no bond. On the converse of that, if I were to get this at 100% finance, leveraging 100% from the banks, you will see here that the bond, the equity is 0, and eventually it gradually builds up to the point where your equity equals your market value because it's now outstanding bond. Internal return. This is a snapshot over 20 years. As I mentioned before, the more money you put into the property as an opportunity cost, your internal return drops quite significantly. 3% in year 1, 6.14, 7.72, etc. And then eventually gradually goes to double digits. Now, if I were to put in no money, that is with money, sorry. So let's put in the internal return, apologies, with 100% cash. And we'll then see that the internal return, okay, in this case, it is actually slightly higher. 11.07% over 10 years. Just see if that lines up over here. 11.7, there we go. And over 20 years, it's 11.6. And you can see over here, 11.6 up there. So that's just on a year-by-year basis. And so you put in 50%, your internal return will just accordingly. This just tells you how hard your money is working. Internal return below is derived from 30% deposit, 30-year bonds, interest rates 11.75%. If you're going to change your loan term, say it's 20 years, it's obviously going to impact your internal return as well. You can actually see how it's going to just impact it over there. But generally speaking, the more money let's just see what the internal return is. We can see over here, it's 10.88%. So looking at over here, obviously paying off different scenarios, your internal rate of return will be adjusted. There's a sentence over here that just explains a bit more detail, but essentially, depending on the property value, etc., depending on your deposits, it will determine your internal return. So in this particular scenario, it's 11.07% on 100% deposits, and with no deposit, you're looking at 10.88%. It might be because of the purchase price. Let's just play around with the different scenario over here. Let's say we're getting 6,500 rental over here, maybe it's 1,500. %, and over here, 10.5. Okay. So the point being is that playing around with different scenarios with this template will help you make a more informed decision based on the type of property you want to purchase in terms of the value, the type of rental you're going to get for it, the costs to maintain and run it, the potential cash flow implications, the finance that you're going to get on it, the loan term. Loan term plays quite a big role. If you're going to have a property manager, factory property management, rental assist I've left off, but there are some cases where there's rental assistance built into the purchase price, which is paid out over a period of time. I've not factored in transfer cost and transfer duty. Once you start doing that, it does change the picture a bit. Obviously, internal return, all these calculations will differ. But also, more importantly, you want to compare it to traditional investments, and you want to see the feasibility of this property to determine whether or not it's still worth your while. But the idea behind this is that if you're obviously breaking even, your money is working more effectively for you because you're not having to pay the bank off. But at the same time, if you are leveraging from the banks, you got the equity that you can use because you're not putting all your money into the investment. You're putting down 50% of your investment and keeping the rest and using the bank to finance the balance. Again, I've changed all the variables here to 150,000, 6,500 rental plus the 1 month vacancy. If I go and change it to naught, you only have 1 year's worth of shortfalls. So as I said, there's a lot going on. There's a little graph over here just showing you the outstanding bond versus the equity. Your bond is going down. And in this graph over here, your equity is going up because your equity is increasing as your bond is going down. So there's a correlation between these two graphs, but it's just nice to show you that your equity relative to your outstanding bond increases gradually, and then eventually, as your bond is settled, it continues to grow if you keep this property, because your market value is always going to appreciate over time. It may not be 6%, but the point is it should appreciate because it is property, brick and mortar. Thanks for taking the time to go through this video with me. There are some ratios over here with the glossary. These are just extra performance metrics one can just look at here, your gross and net yield. These are the most common ones you're going to find on any investment property advertisement. The gross yield, essentially taking your rental times 12 divided by purchase price. Your net yield is taking your expenses, excluding your bond, because it's not linked to the property's performance. A bond is what you get from the banks. And the reason why I've excluded it is because if this property was paid off, it's 6.14%. The property was bonded at 6.14%. You want to know what is the cash flow that I'm getting from this property if it is paid off relative to inflation and also other investment vehicles that I'm getting cash flow from. In other words, you're getting a 6.14% drawdown net of your costs from this property, and the 9.18 is before deductions. The renting value is proportionate, as I said, 6,500 proportionate to the purchase price is 0.76%, or 76%, if you want to call it that, in proportionate ratios. Then you've got the return of investment here, ROI. This is the formula for ROI. I wouldn't spend too much time on the return on investment, etc., because that amount does become quite high over time, which is not really a true performance metric that one would need to follow. Break-even point, obviously breaking even in year 2, so it's 100%, 96.2%, so it's 96.2% of breaking even. If I put down 0, then your break-even point will then calculate it over 13 years, so you'll see your break-even point will get to 100. This is just the percentage of cash flow to debt, so you can see what is the percentage of breaking even. Cash and cash return. The cash and cash return over here is pre-tax annual cash flow divided by total investment. Obviously, there's nothing invested over here. So we put in the 10% over there, and your cash and cash return will then calculate a ratio or formula for you. Capital gain. Obviously, it's the gain that you're making in the property. It's essentially your market value minus your purchase price, and then obviously that differs per year. Obviously, your gain will be relative to the purchase price, so your capital gain is going to get bigger and bigger and bigger and bigger. This is important for tax purposes if you were to dispose of this property. And then, of course, debt to equity is actually no ratio for that. Your debt to equity is basically calculating how much debt do I have relative to the equity that I'm unlocking. So obviously this is the debt, this is the equity. As time goes by, your equity gets bigger, your debt gets smaller. You get to the point where your equity is greater than your debt because your debt is settled. And you can see that in this case, it goes to naught because the property is paid off. So your debt to equity ratio just simply means how much debt do I have relative to the equity that I'm unlocking. And as you're getting closer to the point of breaking even, that ratio goes to naught because your debt is settled. As simple as that. Thank you again for taking the time. It is a very complex template to go through, but do go through it again. Watch the video again if you need to, just to understand what's going on. If you want to factor in transfer duty, you want to factor in transfer cost. Obviously, there are formulas one would apply when you go to do the calculation. If you go to a website, you can actually work out what the transfer cost and transfer duty would be on a purchase price. But best thing to do is go to a conveyance attorney that would be able to quote you on what they would charge and obviously work out the transfer duty on that. That'll be pulled in over here. In this case, there was only 10%, so 10% is 85 plus those two values over there. That then gets worked out into your net present value. It's obviously going to change your intended return to a lower amount. But the point is you can factor in quite a few things into this simulation here to see if this property is worth investing in. But I do think this is a lot more comprehensive than just working out your gross and net yield and working from there. Thanks for taking the time, and hope to make a future video soon. Ciao for now.